You don't get a second chance to fix a bad rotation in the playoffs. The same is true for your money. As of this morning, the national debt is right around $39 trillion. We're hitting a new trillion in less than 150 days. That is the definition of dilution. Meanwhile, Ryan Cohen, CEO over at GameStop, just put over a $50 billion hostile bid takeover on the table for eBay. Is he trolling the board? He's auctioning off personal memorabilia to prove a point, and he's testing the limits of corporate GREENE maneuvers. We're watching a total decoupling. Gas is pushing $4.50 nationally because the Strait of Hormuz is effectively closed. Commercial traffic is down a lot. Today we bridge that gap. This is going to be a long one, so sit back and enjoy. Just know before we dive in, take a look at that progress bar. It's going to be well over an hour. Why so long? Because this recording is coming directly from your questions, DMs I've been getting, and comments over these episodes. You didn't want sound bites. You wanted deep dives into the GameStop, the $39 trillion debt that's over $160 trillion to service, the SaaS apocalypse mechanics. You also asked some questions such as, Marcus, you put a lot of stuff on here, but where do I even start with investing? Where do I start? You want to know, what do I think of the current markets? How can I use AI? How do I use AI? Maybe how do I AI-proof some of my things that I do? I got a cool story to tell you about Jamaica. Trump accounts, that's been a big question here lately. And then I want to share some investment filters that I use. There are plenty of them and plenty more that even I use myself, but just some general ones that people can take a look at before they decide to invest in anything. So before we dive in, I just want to give a huge thank you to over 1,300 people who've joined the Wall Street South Journal this quarter alone. Special shout out to all the people who listen to the podcast. I know we have a lot of people over in Asia, Japan, Vietnam. We got a growing audience over in Jordan as well. Argentina, thank you for the people who are tuning in. Really appreciate it. Like I said, this is going to be, a little bit longer. So we're going to take a little bit of time, sit back and just talk, because there's a lot going on. So people are asking, why don't we just print more money to fix the debt? That was an actual question from my daughter. As of this morning, like I said, the debt's sitting somewhere around $39 trillion, and we're adding over $1 trillion. Right over 100 days, we're adding $1 trillion. Every dollar printed is a direct withdrawal from your family's purchasing power, right? So this is, every time money comes out, your dollar gets weaker. So every time a dollar comes out, it makes your family's purchasing power weaker, like I said. We're watching a total decoupling. Gas is pushing, $4.50 nationally, like I said, because the Strait of Hormuz is closed. And then once again, we just look back at Ryan Cohen and his bid for eBay. I mean, he's selling his socks on there. Is he use it? So if you're using the 1990s playbook in this world today, you're being liquidated. You're being liquidated. Your purchasing power is being depleted as we speak. And once again, it's May, so the stakes are just as high on the court. Depending on what time you listen to this, the Detroit Pistons and OKC Thunders, they're both heading to their game threes, and both may be heading to their game. Yeah, they're heading to game threes, and both may have a 3-0 lead, looking to put their opponents on life support. The Knicks took a 3-0 stranglehold on Philly, and Wemby dropped 39 points in double-double to put the Spurs up 2-1 in the playoffs. You don't get a second chance to fix a bad rotation, like I've said, and the same is true for your money. So this is the playoff edition. Playoff edition is about the logic of the ledgers. We're moving past the dating phase of the SaaS apocalypse, or veteran, and into the marriage reality. Whether you're a new grad who's out here facing the challenge with the SaaS apocalypse, or a veteran investor watching a GREENE power play, I'm giving you the filters I use. So, like I said, some of the filters, but not everything, but some of the things that you can look at. There will be actionable steps that you can take in this video. Sit back and enjoy, take some time. We thank you for watching. And then once again, just thanks to all the people, Japan, South Korea, Argentina, growing, all the people listening, all the people watching. There's a lot of people over on LinkedIn who take time to watch these things as well. So let's jump in. Let's think about the GameStop. How does a $12 billion company with GameStop put in a bid for like $50 billion for each? And then I don't know if anyone saw GameStop CEO Ryan Cohen. He had a viral interview on CNBC the other day where the question was, how are you going to fund this investment? His answer was, half cash, half stocks. They wanted him to get into the numbers since his company is only valued at 10 to 15 billion. We'll go high on the high side. We'll say 15 billion with the stocks and everything. Then he got $20 billion letter, I think from TD Bank, that said they would front that cash to go into a deal or a confidence letter saying that they'll front that cash if they could get the rest of the deal together. But that still leaves a massive gap from the bid that he made, right? So the question was, how is he going to fund it? His response then, and he's updated his response since then, but his response at the time was, look at the website. And then he also said, half cash, half stocks. So let's just think about it. And this goes back to why we just don't print money. Half cash, half stocks. Okay, so let's pretend that, let's just go with the half stocks. Okay, so in order to get to that number with the stocks, he would have to, one scenario would be where he would have to create more stocks. But you only have so much value of a stock. So if you create more stock, it's kind of like a stock split. But it wouldn't be a stock split, but it's kind of like a stock split where one share would still have the same amount of value, it'd just be split into whatever denomination of stocks that is, 1 for 10, whatever it may be, 10 for 1, however it may be. So if you already own this stock at, say, $100, and then the GameStop's not $100 right now, by the way. And once again, these are not investment advice. This is a scenario. Everybody's investment situation is different. But say you are an investor in GameStop. I actually think GameStop was $20 to $30 range right now. Yeah, the GameStop from the meme rush back in the day. Say you're investing in GameStop, but let's say the stock's $100 for math purposes. For simple math folks like me. It's $100, but say Cohen needs to increase his cash to double it from the shares. So he issues twice as many stocks. That $100 worth of stock just mathematically would be worth $50 because it would be cut in half, so it would be diluted that much. But actually, it would probably be even less than that because if shareholders and the markets and investors see that you are diluting the stock for no apparently good reason, they're losing value. The eBay people might not appreciate the value that you're pledging with these stocks because they're going to be diluted. And at that point, you could actually lose more than half the value because the stock could go down lower. Stock could go up. Maybe he's making some kind of master play and the stock goes up. But that goes the same way. That's the same thing when you are using your home budget in dollars. You can't just print more dollars because for every dollar you print, you essentially are diluting the dollars that you have already, right? Or they're having less purchasing power, which is coming also from inflation and purchasing power raises not keeping up with the rate of inflation. We all see what's going on in the Strait of Hormuz right now with the oil and the gas prices people are paying right now, over $4.50 nationally. I think in California is pushing close to $7. And what you have to understand is those are things that are going to take a little bit of time to come back down. I don't know if we'll see that $60 a barrel oil that we saw earlier this year. Oil goes up like a rocket ship, but it comes down like an escalator. So it's going to take time for those prices to come back down. Back to your family's budget sheet, right? So here you are, and they've diluted your dollar down, your dollars by less, right? That's why you don't want to print more dollars. And that's high level, right? That's really high level. There's so many more reasons why you don't want to just start printing dollars, right? Other than the dollar just losing value or actually being diluted, from your self-diluting. I guess the government's actually doing it if they're the ones printing the dollars. But you don't want to just increase dollars. You may want to increase cash levels. That's where the Fed comes in. They come in, they can raise some of the requirements for banks that banks have to hold, or they can change something that interest rates. So that kind of can help with money supply. If it costs more to borrow money, people in theory will borrow less money. And when interest rates go down and money is quote unquote cheap, people will borrow more money. So bad to GameStop. I was talking about Mo Green earlier. So I don't know if anyone's ever seen the movie The Godfather. It's a good movie. It's very interesting. It's some great scenes. People of nowadays are probably, you see a lot of stuff now that was from The Godfather or the first, second, or the third one. You don't even realize it's from the movie. But that stuff is from other stuff as well. Like these are old quotes. Everything's reused. Anyway, there's a scene in there, spoiler alert for anyone who hasn't seen The Godfather. So maybe take a second. But it is from like 1972, I think. But from anyone, so anyway, Michael Corleone, Al Pacino's Michael Corleone, he goes to Las Vegas. It's the 50s maybe, 40s or 50s. He goes to Las Vegas to a man named Mo Green. Mo Green is the head of Las Vegas. He's built it up out there. He goes in there. He tells Mo Green basically that he wants to buy him out. That's what he said. How much would it cost for me to buy you out? That's what he said to Mo Green. Mo Green got extremely upset, to say the least. To put it mightily, he got extremely upset. So he he said, The Godfather, he yells, You don't buy me out, I'll buy you out. Excuse the accent. I shouldn't even done that, but that's just kind of what he said it, right? You don't buy me out, I'll buy you out. I'm Mo Green, and I'm paraphrasing here, but he said something to he was making his bones doing what he was doing back when Michael Corleone was in high school dating cheerleaders. He was just saying he's been doing it for a long time, right? So maybe eBay is Mo Green. I'm not going to tell you more about how it ends for this movie, so that's the spoiler parts I already wrote. That goes. Maybe eBay, old established player, is Mo Green, right? And maybe, although Michael Corleone did not want Mo Green to buy him out, maybe Ryan Cohen's playing some type of long game where he wants eBay to buy him out. Because he was in the interview when he was talking, he was speaking about their fiduciary duty, right? He said, when you make an offer like this, the board has to look at this duty. And the person interviewing him, I think it was maybe Andrew Ross Sorkin or Becky Quick, one of them. It was on CNBC early in the morning. They asked him if he would take an offer from eBay to buy out his company, GameStop, because eBay is worth a lot more stock-wise, purchase-wise. Think about this stuff, eBay's and eBay's actually had a pretty good year, had a pretty good run returning stock-wise. Once again, not making stock recommendations, just talking about situations where we are in the world right now and just a comparison. Once again, this ties back to you, Main Street, back to our dollars, back to how they work. But so yeah, eBay, like I said, probably doesn't want to buy GameStop. I don't even know if Ryan Cohen wants him to buy GameStop, but when he makes that offer, or even when they put that in the media, that's also another thing. Like, just when they say that kind of like that out loud in the media, that board kind of has to listen, right? Because it's kind of like an offer, maybe not an official offer, maybe not a hard offer. You just saw this play out with Paramount. Another thing with offers, like, so there are several things that, and I digress a little bit, but just for anyone out there in the world, just a little Main Street information. There are several ways that you can respond to an offer, right? You can give a counter offer. You can just reject the offer. You can say nothing to the offer, right? Which is like rejecting the offer. You can accept the offer. A few ways with offers. That's legal business contracts and offers, right? That's how that goes. But as a board and fiduciaries, eBay's board has to look at that offer at least if Cohen can present a proper offer to them, right? They have to do their due diligence just to see if like what he's making, the offer he's making them is going to provide the most value to their shareholders. Because that's one of the things about being on a board. You have fiduciary duty. You have to provide the most value to your corporation, to your shareholders. That's one of the lenses you have to look at through. I know it because I've been on boards, been on nonprofit boards, so it's just a way of looking at board of directors. Also on an advisory board, which is different. Not quite the same fiduciary standards. We talk more technical there, more investment, more strategy, but just something to think of. Once again, like I said, I digress away from this. But just to say that when Ryan Cohen went on the air, he made the offer, the statement like Sunday night. When he went on the air, he put some pressure on eBay. I guarantee you eBay's hired some real expensive lawyers to start reviewing what he said to see if that stuff makes sense. Money-wise for them as a corporation, as a board. And then if they come back at him, like I said, the Mo Green analogy, and want to buy him out, who knows? Who knows what he wants to do? But he has definitely grown GameStop. He's a smart dude when it comes to that kind of stuff. He helped with the memes. The community that he has is behind him, supporting him for sure. They think he's playing chess. I don't know if anyone said, other than the other day when they mentioned, what if eBay was looking to buy them out? I don't think maybe that's been breached again. Like I said, he's had another interview since then, but that was a very interesting thing. And then another thing, just tied it in, he has an auction where he's selling things on eBay. They froze his eBay account. I think it's unsuspended again now, but he has some stocks on there. They're up to like $14,000, man. So I don't know if he's like trying to goad eBay, but that's stuff not really, it's rarely ever seen. It's very, very interesting. So think about that. If you're, once again, be careful if you're thinking about investing in GameStop or eBay, that stuff's going to go whatever it's going to do. But that's how it works. And then think about why we just don't print more dollars. That's just one of the reasons why we don't print more dollars. I can make a whole video on why we can't just print more dollars. Like, can't just print more dollars. It would actually make it harder to service that debt as well. So like I said, eBay. Now let's jump into the S&P. Like I said, another question people have asked me. Let's see. What do I think of the current markets? All right. So the current markets right now, they are, once again, not investment advice, but the current markets right now are very, very, very interesting. Like stuff that's happening inside these markets they're not exactly making sense. When you're in a geopolitical conflict involving oil as one of the main commodities, you would generally think, and this was happening When oil prices went up, stock prices would go down. When oil prices went down, stock prices would go up. But what we started to see was this just incredible exuberance in the market right now. I mean, the market is really trying to get to 8,000. I don't know where it's trying to get to at the end of the year. Not a market call, not a market prediction. It's just this market is running really hot. And I was telling the person who asked this when we had this conversation yesterday, and this was just a conversation, just a question. It's like, I just laugh, and not because it's funny. It's not funny what these markets are doing right now, how they're running. A lot of people are making a lot of money, but this thing can break, and when the momentum breaks with this, because this market is very momentum driven. When this momentum breaks, when this momentum breaks, eventually it's going to break. What goes up must come down. It could be hard for some people. It's going to be a big, hard hit for people coming back down on the other side. So here you sit with these companies, you sit with the markets at all-time highs all the time. So we're just consistently beating all-time highs. After we had the SaaS apocalypse back in February, March, I think we saw the bottom. Maybe it was the end of March. April was historic with the returns that we saw in April and the speed of the recovery. Now we've gone to May, and May's been a pretty strong start as well. That being said, as we're sitting here recording this, who knows what next week holds? As we sit right now, currently, we have Iran and the United States discussing a 14-point, one-page plan. So to keep the ceasefire going, shots are being fired over there, but the ceasefire is still holding. Okay. That has put pressure on oil prices, and we see that at home. We see the pressure on the oil prices. So we see one way, and I was having this conversation with my stepfather. Shout out to my stepfather. He's a good man. But one way, we were having this conversation, we were sitting at lunch a few weeks ago. He asked me what I thought about oil, what I thought about the gas prices. I told him, depends on how long this conflict lasts, but I don't think we're going to see, like I said, I don't think we'll see the $60 prices level again anytime soon. He was like, what are you basing on? Because he knows I don't just base what I say on feelings, or I'm pretty analytical. I'm really analytical, actually. And this isn't exactly analytical what I'm talking about, but I just told him I was looking at the futures. So you got to look at the futures with oil and prices and see what people are paying months out, So I think oil was like $110, $120 at the time. And this is before it came down and went back up like we've had recent. Because it went down, that's when the stock market started its rally. But it's gone back up with I think it went down and stock market started its rally when they introduced the 2-week ceasefire. But it started going back up when some of the tensions were mentioned or re-escalated oil prices, as did the stock market. But once again, so I told him, I said, I look at the futures. Like you look at, and I don't trade commodity futures or anything like that, but I look at them to see oil prices, see where oil prices are going to go. And I also look at history, So we were looking at history. I told him historically, more times than not 8 weeks or so after those first shots are fired, what we've seen from conflicts in the Middle East with U.S. or even Ukraine and Russia, 8 weeks later, the stock market is higher, oil prices are lower. And about the 8-week mark, it was pretty, congruent with that, because we're in our second month now, pretty close to those timelines, as they have extended this deadline for the peace talks, hopefully to build upon this one-page agreement they have to extend for 30 days. But oil at that time was $120, $110. The futures, towards the end of the year, $80, $90. So I don't know what the oil price would be, but I know directionally it'll probably go down, because that's also, we're in a midterm election year, and affordability is one of the things that the current administration ran on with the sweep that we saw, the red sweep, was a lot with affordability. If you go into an election cycle where people are paying $4, $4.50 for gas, it's going to be hard to sell affordability to people. I'm not a politician. I don't do any political messaging or influence. I don't push any political agenda on here, but I'm just saying it's going to be hard. Historically, parties and power shift at the midterms in this type of election cycle. So we'll see. I mean, there's just a lot of interesting races as well. We have competitive races right here. I'm down here in the Wall Street South, North Carolina, Charlotte, North Carolina. Shout out. Tom Tillis' seat is up. So we have a couple of people running there, Michael Watley and former Governor Roy Cooper. So that will be an interesting race. We have interesting races in Texas as well. Several other places just have a lot of interesting races, not to mention the interesting things going on inside the DHS. Well, yeah, DHS, but interesting things happening with um, the House of Representatives right now as well, and also the Supreme Court. So there's just a lot of things going on right now inside the market, inside geopolitical tensions that even outside of oil and the war, that's what we're talking about. That's what we were talking about. It's always interesting to see. I remember when the Ukraine war, I remember a lot of wars, unfortunately. You can tell by the gray in my beard. But I remember when the Ukraine war started a few years ago, it was like they showed the coverage. That was the first thing when shows came on. They would talk about the war, the war, the war. And then eventually they stopped showing that first. Got pushed back to maybe the second segment, maybe the second after the first commercial break, et cetera, et cetera. Starting to see the same thing with the Iran war. Now, when it comes on with our national news and things like that, there are other things that people are talking about. So that war is getting pushed back, which also makes me think that this may be a prolonged conflict with hopefully the shots and ceasefire. Hopefully the shots hold off, the ceasefire holds, so hopefully we can see these types of continued improvements and we can take that off the table. But it seems like the market, and I know the market is not the economy, is taking it off the table. But we can talk about the economy, the micro, the macro, how it hits you. Yesterday we had a jobs report that came out that was expected to be maybe 55,000 jobs. And I think it came in at 155,000 or something. It was like double the expectations. It just showed that, well, at least with that report. And people have their own opinions about the data, but it showed with that report that the job market, the labor market is strong, extremely strong. Then we had inflation numbers come in, I believe lighter than expected, if I recall correctly. One of the last labor reports, but we also had, I remember, a high, like 3.3% PCE coming. So that was, there's a lot of dynamics inside of this market right now. So that's why I'm speaking so long on what I think about the market right now. Just know that I'm trying to help Main Street understand, just trying to help you understand my perspective on why I see the things that are moving. So just some things to think about, like when you look on the news and you see and you wonder about gas prices, like how long is this war going to last? That's, you look and see gas prices outside when you go and get gas. That's the thing about inflation as well. Like we feel it ourselves, right? We feel it when we swipe our cards, when we insert, whatever you may do, tap your phone. However you do it, you're going to feel these things. So you feel the inflation, you feel the pinch at the pump. You feel the pinch at the pump. You feel all these things. It's pressure on Main Street. It's pressure on households. Having a conversation in my house, me and my wife were just talking about like how these bills are so much more. And I was like, yeah, baby. Well, I mean, I don't even know if we're using more of anything. I don't think we're consuming more. I think we're actually consuming less, but everything costs more now. It's just so much inflation in the system. And granted, inflation has come down from where it was a few years ago. So inflation is just a battle that the Fed's been fighting just way too long. That's something they need to get in control, but that's obviously easier said than done. So we don't know where they're going to turn their focus to the inflationary side or to the labor side. The labor side seems to be coming in strong here, at least with the last report. Even the ADP number was pretty strong before we got the official government number with the labor report that came out on yesterday. Also, we see, so still inside, like this is still going into my market thoughts. Like what all am I seeing in the markets? What am I thinking about in the markets? We have Kevin Warsh, who will be appointed presumably next week or soon. Also next week, we have President Trump going to China to speak with Xi Jinping. So that will be interesting. I don't know, maybe the U.S. wants to have some of this stuff with Iran wrapped up. That was one of the reasons why they originally pushed the meeting back with Xi, was so that we could try to have some stuff wrapped up with the Iran war. But what it seems like maybe people forget is that this involves more than two parties. So it's not like tariffs where one side. I mean, tariffs involved other people, but pretty much one person, President Trump controlled that lever as to whether or not tariffs were going to be implemented, the levels, when he was going to take them off. Stock market moved with that. I was suggesting then stay invested. Don't try to play these market moves like that. Unless you know some stuff, which is another thing, which people, maybe some insider trade going on. We see a lot of crazy trades going on. We saw the trade for like hundreds of millions of dollars that was made 70 or 90 minutes right before the announcement that made oil drop significantly, maybe the 2-week ceasefire that I'm speaking about. But yeah, so in that situation, which is illegal, like you can't be making bets on that. Those people are going to get found. We saw the soldier who profited $400,000, I think, when they went down into Venezuela and took was it Venezuela where they took the president from? Yes. And it's just, there's a lot of things going on that you see happening. Venezuela also ties back to oil. It's one of the largest oil producers in the world. The United States essentially has control over most of the oil in the world. All this stuff ties into the markets and my market view, right? Because once again, I said the markets are like oil should go down when these stocks are going up, or they should have a reason, right? I do have a reason why these stocks are going up, though, in spite of that, because once again, like I said, I'm analytical. So there is a reason. I have a reason for it, I think one of the bigger reasons that we have this move in stocks is earnings. People have forgot about earnings, right? So the earnings power is pushing through right now. We are seeing strong earnings reports from the corporations, right? Everyone seems to be beating expectations. I think earnings were projected to come in around 12 to 14% this quarter so far. And most of the companies have reported so far, like especially like the big ones, most of the Max 7 companies, those companies like that. So far, earnings are up like 26 or 28%. So selling that for a second. Projected 13 to 14% earnings growth in the first quarter, and earnings are double that. And that's after all this stuff I just mentioned, right? Before this, that 15-minute tangent I was just speaking on about different things that could be happening in the market, which there's still more that I could speak on because I haven't even spoken about like Kevin Warsh and Chairman Powell. I briefly spoke on the Fed. What are they going to be able to do with these interest rates? Are they going to be able to cut interest rates? Are they going to have to raise interest rates? There's not even any projected movement. If you have to look at these notes the Fed puts out, and sometimes polls are, we all know how polls work in this country, but they're not projecting really any movement maybe until the end of this year or next year. And it's like, it could go either way. It could go up or it could go down. It could go up or it could go down. So we got rate cuts or we got rate hikes, which was not in people's base case going into this year with investments. People were not expecting rate hikes to be in the question. People were actually expecting rate cuts to come into play, which would in theory, should increase spending as money becomes cheaper. Businesses make more investments, but with businesses and investments, you have the O3BA. You have that bill. Shout out to Kevin Thompson. That's his saying. So you have that bill that help business owners. It really does help business owners, right? It's after a conversation I had with Kevin, and I've looked at the One Big Beautiful Bill Act extensively and for well over a year. I was looking at that thing before it was signed, when they were first talking about it. You can check out some videos that I have there on my YouTube channel, like a 2-hour dive on it. You can go back and see it. Receipts. Y'all know I'm all about receipts. But inside that bill, there's a lot of things for business owners. Accelerated depreciation is one of the big things inside there, where you can just pretty much write off. I don't want to say you can write off anything, and this is not tax advice. So, but there's a lot of things that you can write off. Business owner over here, on the ABC Squared financial planning firm down here in the Wall Street South. But there was a lot of things in there. And then you also had things for individuals, of course, obviously, the Trump baby accounts. We'll get to that later. We'll get into the OBBA later on. And the baby accounts, we're still talking about my market view. Yeah, this has been a long part to talk. Thanks for everyone who's still listening. Appreciate it. Like I said, this is going to be a longer one just because there's so much to cover. And I want to give people the answers to questions they've been asking, because some of these answers, when I give them to people, they are like 20-minute answers. I just sit and explain to them my reasoning. And that's kind of why I'm giving you all right now some of the investment theories, things maybe that I make. Once again, not individual investment advice, but things to think about. I want to help people through financial literacy by giving information so people can take this information. You can digest it, you can evaluate it, and you can make an informed decision yourself, right? That's a good way to help Main Street meets Wall Street. So share this with people who are listening, who are watching, who are not in this community, who could benefit from this, right? Like I said, with the podcast, sometimes we want to go solo on the podcast. And the good thing about going solo is I can go for a long time when I go solo. There's not really any restraints on time as far as that goes. So just a lot of things inside of this, still sitting with the stock market. People are asking, what's my stock market view? I got a podcast episode coming out with David Snyder. He called the market bottom in 2008 and also called it when it was come back up in 2009. He's very analytical, very technical. That episode is coming out later in May. I recommend sitting down and taking a few minutes to listen to that, because it's going to be dense when we talk about this stuff. He's actually calling for an AI bubble that could happen. Yeah, I'm not even burying the lead. I'll just let you know because it's on the YouTube channel somewhere. It's the clip. He's calling for the AI bubble, and he said it on CNBC. So he said it on TV. It's out there. But he thinks the AI bubble is going to come. He's calling for it to happen, after these IPOs. That could be some of the big things that we see. So SpaceX, OpenAI, Anthropic. He said after all three of those go, and I'm 50,000 feet up here with this, right? Compared to how deep he goes into it. We go underground from the 50,000 foot on this. But he thinks once those three companies become public, there'll be so much money pushed out that that'll essentially pop the AI bubble. A lot of other things that he puts inside there, maybe these companies can't return. The CapEx is too much. He definitely has historical perspective. He has 45 years of experience investing. He writes like 10 to 20,000 word research papers on this stuff. And his research is cited and used on these fancy networks that we hear. He's very intelligent, smart guy, just very analytical as well. And he goes deep in that. So look out for that one when it's coming out as well. That podcast episode. Back into the market, right? So the market view, where were we at with the market earnings? So earnings are coming in strong, right? These earnings, but they're concentrated, right? The earnings have been concentrated. And that's not to say that these other companies aren't performing, right? Like some of these companies, if you look at different regions of the world, it's diversified. People were pushing for American exceptionalism trade, quote unquote, air quotes for those, I use air quotes for those listening. The American exceptionalism trade where it was coming through, and that trade worked. I don't care what anyone says, that trade worked 23, 24, 25. You were still making money in the stock market. But if you had a crazy heavy 23, 24, if you had crazy concentration in like the USA, which probably meant you had a lot of tech, that type of stuff worked like really, really well. But you saw when it came back down, people lost a lot of money. And people who sold, those are people who really lost money. People who stayed the course, they continue to earn. Because this bull market is running at a historic pace right now. Another thing David was mentioning about stocks. So this is, once again, I'm still giving you my whole stock market view. This is me getting dense, not just sitting here with other quote unquote experts. This is actually, what I digest, what I process. I spend my time watching this stuff as well too. But, 17-year bull market, right? So are we in year 17? We're in year 16. That's one of the questions people have to ask where we are in the bull market. Also, coincide with that, I don't know if anyone's seen the ESPN series, the 30 for 30, but the episode called Broke, I actually wrote a newsletter on that because that was 17 years ago as well. And it was talking about athletes, how they go broke. It was very eye-opening to see that episode again because I saw it when it first came out, and now we watched it again a few weeks ago. And I wrote about it a couple of days ago. So in the Wall Street Stock Journal, there's an article in there. But just to see like some of the things that they had inside there that they put for the athlete. One of the things inside there was the model portfolio for the athlete. That really jumped off for me. The model portfolio they had for the athlete at that time was, I have to look at the newsletter to see the exact model portfolio, but it was like 55% equities. I'm looking to see if I can find it. It was like 55% equities, and maybe I'll put it in here later. 55% equities, 55 to 65% equities, 15 to 20% alternative allocations, 5 to 10% private credit, and there was another allocation, maybe cash equivalents. But it was, it was fairly diversified. And, they mentioned that you need to have different, I'm trying to find this on here. I'll just put it in later when I do the edit for people. But they mentioned that you need to have different, be diversified, obviously, outside it. And it ran the math. I used AI for that. So people ask me how I use AI. I used AI for that math, because that's just not, that's not my client. So I'm not doing that client math. I'll just let people know inside of the newsletter, hey, this is math that AI used. AI created the math. So take the math as fuzzy math at best, because AI will definitely give you some interesting math. But the returns, I think they were like 12. It started at 12 million and it ended up, it started at 3 million. 3 million was the base. It went up to like 12 million or 35 million. But the other scenario was like 100% all stocks. And that actually returned, I guess I can just go to my LinkedIn page and show you. But that actually returned a much greater return than the portfolio. But it mentioned that you would have to stay invested inside of those positions for the entire time that this market went down, some of the crazy moves that happened in the market. Because you got to think, when this episode aired in 2009, this was right before, right during the housing crash. But like I said, it began the bull market. So if you were invested 100% in stocks, wow, man, like that's going to be a ridiculous return. That's going to be, I'm pulling it up. Let's see if I can me a message. All right. Yeah. So if someone invested, I don't know, like three million in stock, here we go. Look at these allocations. We'll just look at here. All right. So that's the allocation for the portfolio. So 50 to 60% securities, 7 to 12% real estate, 5% private equity, and then 15 to 20% alternatives. Right. And it was live like a king for a year or a prince forever. Right. So think about that. Right. And it was broke. 17 years later, has anything changed? Has anything changed? Bart Scott said that the Ravens owner told him that he could live like a king for a year, or live like a prince forever, and that just kind of opened his eyes. I'm just scrolling through just to see where those numbers are. But while I'm scrolling through, some things you should think about that we don't see. So for those who can't see right now, I'm scrolling through the page, but through the newsletter, this edition, the Wall Street South Journal. But the invisible drain, so taxes are, they're a big part of it. And then blind trust, so people that you trust, financial advisors, agents, or family members, they can lead to disastrous outcomes. We've seen Bernie Sanders. He was on there talking about how he just gave his checkbook over to his father, pretty much, who really didn't have any experience with management of money. Heard so many stories. They were talking about Michael Vick, who he was taken advantage of by his financial advisor. So, and I am a financial advisor. I'm a financial planner. So I wanted to point that out to people. You got to be careful who you are operating with, and who you're trusting your money with. People need to take great care and duty with your money and your life savings. You need to understand what you're investing in as well. But also, it was inside that the difficulty of saying no. So whether it's a cousin or someone with surefire thing, they mentioned car washes on that episode. People seem to invest a lot in car washes, but whether it was a car wash, whatever it was, they just mentioned a lot of bad investments. And they give a lot of examples, and they're just terrible investments that people came to them with and that they actually made. And then the big one, so once again, part of why I'm doing this, the financial literacy gap for people, that's one of the big ones, And like I said, that's one of the things I want to do. I put in the newsletter, I don't know if you remember this commercial, people, the camel with the biggest hump has the most water. That was what a man told his daughter on a commercial when she asked him for some financial advice or investing advice. I always thought that was funny. But that's what people are telling us, right? That's what we're getting, right? But, and then it talks about the path forward, the Prince Forever strategy. Here it is. So here's the performance. Okay. So I'm sorry for those who are listening. I'll try to visualize it for you as much if you can't see it. But $3 million initial investment on March 23rd, 2009, 60% equity, so 1.8 million. The S&P saw 800%. 5% private equity, 150,000. And this was just based on what it typically aims to return, 12 to 15%. And that's even what I'm seeing right now with some of the private credit and private equity that people are bringing to me for some of my clients. That's about the range. But that's a whole nother issue, private equity and private credit, because you have to really, truly understand what you're invested in. It has to be money that you can't. It has to be money that you can stand to lose 100%, but it also has to be money that you can't, that you can stand to have locked up for a while, because it's a liquid, like I said right there. Then real estate, 300,000. So even after 2008 stock market, real estate, it entered a long recovery. Real estate struggling right now, but rental yields. Some people only invest in real estate. And then alternatives. So gold, we saw gold with a significant run. Hedge funds underperforming, but they built that buffer. So diversification side of that. And then, that's, if you hadn't seen one of the live episodes, this is only on the YouTube channel. It's not on the podcast, but I did a live with Clem Miller, a professor over at Georgetown International Business Professional. We spoke about right after Chairman Powell's last speech, presumably his last speech. Hopefully, I don't want to say hopefully, I don't know. I don't think he'll be there next time. He was speaking as if it was his last speech. So, but another thing, so I'm sorry I'm sitting here on this portfolio, but this is actually some pretty important stuff, right? Because this is financial literacy. This is people who are still, the same things happening. Like the question, what has changed? What has changed? That's what I'm asking. What has changed? How many people do you know right now who had windfalls of money? We've all wasted some money. But if the same $3 million portfolio had been placed entirely in 100% stocks, tracking the S&P, the SPY, so like the United States stocks, the results would be significantly higher. March 23rd, 2009, you would call the market almost exactly at the lowest point following the great financial crisis. And I picked March 23rd, 2009, because that was the date on the episode. When they were talking, they showed that date from like when they were recording. So that's the date that I put for the time. Nothing to do with market returns for like tracking that. That was just the date. So 100% equity. So just, I want everyone to think about this too when it comes to investing. Like this is data. So past performance doesn't um, represent future returns. Nothing is guaranteed, but this is kind of direction and momentum that you can see, like how that diversified portfolio did well. But they even let me show. Did I even say how much it was worth at the end? At the end, where's it at? It's somewhere down there lower. So 100% equities, $3 million. It said the approximate return would be 950% to 1,050%. And once again, this is AI math, but the multiplier was 10.5 times. Your estimated portfolio value would be 31 to $33 million. And then, it just talks about diversified versus 100% stock. So you're comparing the two strategies over the specific 17 years. I'm sorry, I'm reading this newsletter, but there are some people who don't even have access to LinkedIn, haven't connected with me. Connect with me on LinkedIn. You can check this out. I got other editions too, talking about the debt, talking about all kind of great things, and not great things, but prudent things, hopefully breaking them down where people can understand. Things to help Main Street really understand what we're in the midst of right now. And I'm still talking about my market views in case you think I've lost track. I'm still talking about my market views with this broke thing and how you're invested and just seeing this return is so important. People need to understand. So diversified portfolio, there it is. So like $15 million, right? I mean, come on, from $3 to $15 million, people really, you shouldn't really complain. But like I said, provide a smoother ride when the market dips in, 2011, 2018, 2022. The gold, real estate, and hedge fund components act as a shock absorber, right? And then 100% portfolio, about 32 million. So the ending balance is more than double. The investor would had to endure extreme volatility. Watch the portfolio drop over 30% in a matter of weeks during 2020. Then they had to see the 20% decline in 2022. But that's where hopefully you have a financial advisor who is explaining to you, or someone, or you've had your own mindset. It doesn't have to be a financial advisor. Maybe you had your own mindset to where you understood that this is a long-term investment. If you have money, you invest it more in there. Because if you're investing for the long term, like if you were someone who were retiring in 2020, oh my goodness, that's tough, or 2022, you had to adjust your retirement strategy. Hopefully you didn't just still retire the same way. Hopefully you adjusted. Maybe you had to work a little bit longer. Maybe you had to take less withdrawals out your first year, but you had to adjust if that was the case. But if you're someone who's still investing or someone who still had time horizon, you were fine. Still talking. So why the gap is so wide? Dividends, reinvestment in this scenario. So 100% stock dividends reinvested. That compounded aggressively over 17 years. According to share math, the dividends made up a massive portion of it. And then it actually said the alternatives were dragging it. So one of the greatest bull markets, and yeah, I mean, compared to the stock market return, insurance assets like gold and hedge fund actually lowered the ceiling. While they reduced the risk, they also reduced the final payout during a period where growth stocks, tech dominate everything. That's interesting. Think about that, what financial advisors are saying back then. That private credit that people are worried about right now, so worried about right now, was actually put in there. And it's still in the right portfolio for the right investor at the right time frame, the right risk tolerance. That's a lot of right. There has to be a lot of right to put private credit in there, but it actually does present a way to reduce risk and sometimes produce income inside your portfolio. But like I tell people, I guess I'm bearing the lead inside that because it's one of the things when you invest in something like that, you need to be prepared to not invest more than you can stand to lose completely if it's something like private credit or some type of alternative. All right. And then once again, it was the perfect time with 2009, was the launch pad. If you actually bought into the market right then, you're going to be rewarded extremely. And this isn't even like investing more money into this. So this was an athlete salary of $3 million that kept going. So like I said, roughly 17 million more in wealth, but you had to stay disciplined. But that last sentence, like I said, who stayed disciplined? And that's another look, a better look at the allocations. But once again, people aren't like that. People don't invest like that. At 15 million, people would be so upset if they missed out on that 32 million. This right here was very eye-opening because this was actually the projected amount that, let's see if I can make this large. Here we go. This is larger. So this is the projected amount that athletes were actually invested in at that time. So they don't have the percentages, but that's over half of it is private equity for those not watching, or for those, for those who are just listening, who can't see what I'm on the screen right now. Then the second largest slice of this pie, so it's a pie graph, is alternatives like gold. Then the actual smallest part is securities, and then real estate. So that's how they were actually invested. I'm going to scroll back up to what was suggested. Now I got larger. And if you look, it's pretty much flipped over actually from securities versus private equity. The suggested model portfolio in 2000, I don't remember the investment financial advisors who were on here who suggested this portfolio, but it's on the ESPN documentary. So just pull it up and look it up. This isn't my portfolio recommendation then, now, or anytime. This is what this is theirs, So just note that as well, because once again, this isn't personal financial advice. This is just and you need personalized financial advice. But that's really jumps out to me right there. The model portfolio that they suggested versus. So for those who were just tuning in, or those who hadn't heard, the model portfolio, according to ESPN back then, and not ESPN, I shouldn't say, according to these financial advisors, because we have to be careful what we say and how we say it. According to financial advisors back then, a safer investment advisement would have been 50 to 65% securities, 7 to 12% real estate, and this is in a pie graph, 5% private equity, 15 to 20% alternatives. But once again, those numbers are, there we go. That's the actual portfolio breakdown, where over half of it was private equity, alternative securities. Like securities is the smallest portion of this pie chart. Alternatives is the second largest behind private equity. So it's very, very eye-opening, and just hopefully people, if you don't have to know an athlete, you just have to know someone who has come into a windfall of money at an early age, and they don't know what to do with this, and they're getting hit from all sides, and it's everywhere. I'm going to stop sharing my screen now. But, oh man, we just need people to really, really take time and think about what they're investing. Another thing inside of private equity and private credit, and I have a longer video on the channel diving deeper into it. I have actually a few videos on it as well, actually. But you have to know what you're investing in. It's not just private credit and private equity. It's anything that you're investing in. You have to know what you're investing in. Otherwise, you have to know what you're investing in. Otherwise, you're just throwing your money away. Sorry, I took a drink of some Deer Park water. But like I said, I'm talking about markets. I'm talking about my view. I'm talking about, so say you've earned a lot of money inside these markets. This is where we're at, right? What I just talked about, what could happen with it, with just going into that breakdown from ESPN and the newsletter, the Wall Street South Journal. I just wanted to show that to people watching, and I wanted to listeners to hear it. Some of the things. I hope I did a good enough job. I hope I did a good job explaining that verbally for those who can't see it visually. But now let's jump into, so I've given you some of the things, but we're talking about earnings, right? So we're talking about the earnings inside of the S&P, and it's the playoffs. Like right now, there are literally games happening as I'm recording, but I don't know who's winning the games. I'm not watching the games right now, but it's the playoffs. The game's going on right now. Inside of this, I like to have the S&P compared to the playoffs right now, right? Because the S&P, like I said, those earnings were strong, but a lot of it was driven by 5 companies, right? So sit here with me. Let's go through it. Think about this with me for a second. Google, Google, Alphabet, they're like the OKC Thunder right now, okay? So just think about them back to last year in like April, like right when the playoffs started. Think about where Google's stock was, or even before the playoffs started. It was really, really off its highs. It was like 21 times earning. There's actually an article that I did with Samuel Brent. Shout out to Samuel, Business Insider. We have some videos on here. When we talk about Google, we talk about a lot of these stocks that are actually in here that people, quote unquote, the experts start talking about later. But we talk about Google. I made the case in that article that Google is really underpriced. And once again, this is not investment advice, so don't think any stocks I'm about to tell you are investment advice, because they just fit a different term. Some of these things have moved so much that they won't make sense. But I will tell you a stock that I think is like Google last year. It's going to be this year, but we'll see. But anyway, not investment advice, but comparison, just explaining. So Google, like I said, Google is OKC. Last year, Google was like 21 times earning. People were so concerned about Google. But a point, like I said, Google Alphabet had so many components that people didn't even think about. Once again, it was already extremely undervalued. And then it had Alphabet had, what do they have? They have YouTube, they have Waymo, they have so many things just inside of them. And that's not even talking about, the actual Google search that people were talking about and that people use. That's one of the biggest things. People were saying search is dead. Oh, search is dead. Google search is dead. But Google's like, I'm going to grow inside this AI field that people don't even realize. We're going to start making Alphabet. We're going to start making chips in-house. We're going to build a whole stack in-house, right? And that's kind of what OKC did, right? They went and got SGA, who they traded for from the Clippers, but the rest of that team, they pretty much built in-house, right? So they built that stack, like your stack inside is tech, right? So you have, and this isn't any push for NBA team either. It's just kind of how they how they compare. So they built a stack. They drafted Chet Holmgren from I don't remember which college he went to. He's really tall. He's like 7'4". Then they got a couple Williams guys who were really, really good. They just built a team that works really well, right? So it's kind of like the stack that Google built, like they're just showed with their TPUs, and then they have the cloud and the MVP, the MVP of this time, because we just saw their earnings, was Gemini. Gemini increased, oh man, what, like 25% growth inside it, or maybe more. It was really high growth inside Gemini. So their AI assistant, and that's like SGA for them. Like, so their MVP that carries the load at the end, their leading score, whatever. This time it was their leading score, where search used to be their leading score. That may almost be like and I'm definitely not getting ahead of whether how good or great this team is, but that's kind of like when Jordan led the way for the Bulls, he was search. And, and that Bulls team was great for those who don't watch. But anyway, so you got the stack right there with SGA as the Gemini of this whole thing inside of Google, right? So he's the thing that is the strongest in the market right now for what they have, the public market, and they play as a team. Maybe they can repeat this year. I don't know. Then you have, NVIDIA, right? NVIDIA, people talk about NVIDIA, once again, not stock investment or advice. It's just what we've seen with returns. NVIDIA hasn't reported returns, has not reported this quarter yet, but you kind of infer from other companies how NVIDIA is doing. Because NVIDIA pretty much, other than Taiwan Semi, they pretty much get fed some money from everything AI, like when you go into the chips, because people use their chips. They have TPUs too, and GPUs. So when people, and they're ahead of the game. Most people have heard of NVIDIA. NVIDIA is kind of like the Spurs right now. The Spurs and Wemby, right? That guy is generational. With his talent, people are talking about how great he can be. We'll see. NVIDIA's holding it down. NVIDIA's back. I think they hit all-time highs just the other day again, pushing strong with their chips, Rubin, the rollouts that are back inside of China, now selling those chips and fabs inside those factories and teaming up with everyone in America, to produce chips, Intel, companies like that. So NVIDIA's strong. You couldn't go wrong if you were, investing in there. Once again, not investment advice, but just like if you're thinking about like types of teams and builds that you have inside. Although I don't know if Jensen Wan's, even though he's shorter than Wemby, I don't know if he's a bigger star than Wemby. I don't know who people would recognize in public first. Probably the 7'4" guy. But it's just NVIDIA's in there. They're inside of it. And then the Spurs, they're a team that's been there before. That organization is strong. People think NVIDIA just popped up. NVIDIA is pretty old as far as a company. Not old, but for a tech company. I mean, NVIDIA was around, early 2000s. So they've been around for a while. Jensen's been doing this thing for a while. They started small cap, grew into this large cap valuation, into the actual, I think they're the most valuable company in the world. Depending on the day, I think Apple may have overtaken them sometime earlier this month or within the last 30 days, but they retaken that mantle. So it's just like, there you have it for NVIDIA, and they're the players that everyone kind of just has to game plan for, like with Wemby, as far as like, that's where it starts. But they also have other pieces that people are helping. And they also invest in almost all the AI companies, a lot of AI investment, but it all comes back to NVIDIA. I think Jensen Huang said, like, I don't know, it was something silly number of every dollar that goes into AI comes back to NVIDIA, maybe 10% of every dollar. Anywhere that goes into AI investment somehow makes it like 10% of that makes its way back to NVIDIA. Those numbers are different, but it's crazy that they are that entrenched into the AI world. But like we said with Google, maybe they're doing something different, or Alphabet, where they're creating their own chip, and maybe they're just disintermediating that level. People could be worried about Taiwan Semi, a company over there, if something was to escalate and we couldn't get chips from Taiwan. But we'll talk about more chip stops in a minute. So Apple's got to be the Knicks right now. The gritty veteran. They just put out some really strong numbers, over $111 billion in revenue, but they're switching CEOs. Tim Cook's on his way out. John Turnus is on his way in. So that could be something taking over this September. You got the solid bench, but it's being tested. So, Apple's had a lot of CEOs. I don't know if people realize, Apple had a lot of CEOs back in the day. History just kind of looks, at Steve Jobs and Tim Cook. They were the last two. And they definitely taken this company to, one of the greatest companies in the history of companies and in the history of the world. You can argue it all you want, but if you invest in Apple a long time ago, you probably are not disappointed in your returns. Think about Apple. When you think about Apple, they have a lot of things going, a lot of different ways that they can compete, a lot of different ways that they can subscribe. People are talking about phones again, but I think one of the bigger things with Apple, and I was actually on Korean TV and we were talking about stocks. They asked me about Google and Apple, and this was in January, February. They asked me to pick, and I was like, I actually like Apple. It's Apple, and I'm not picking this out once again. Don't take this as stock advice. It was just picking if you had to put out. The point was, if you pick Apple or Google at that point, you would be fine. Pick them both. Pick a little bit of both. You know what I'm saying? If those are your two choices, because they're such strong companies. Apple has people are talking about phones, but what people tend to forget about is the built-in subscriber base Apple has, right? Apple has half the consumers in China. Apple has billions of consumers across the world. I know that my Apple payment comes out every month for my subscriptions, and I'm not the only one. Also, people were complaining about Apple not spending enough money with their capital expenditures. So maybe people talking about the Knicks not going big enough in free agency. But I don't know if you noticed, Apple, I told people Apple, and I said this on the K-Pro TV, I said Apple just kind of always figures out a way to win. Apple doesn't have to spend. They don't have to be the first to the market. They don't have to be first. They want to do it the best. So they'll figure out a way. And what you're seeing, they actually teamed up with Google at that point. That's what it was. That's why the question was asked, because they teamed up with Google at the point. They just announced a partnership where Google was going to put Gemini. Google is putting Gemini on the side of Apple's AI. They're helping Apple with the AI and Siri, which is meant to be a big upgrade. But like I said, Apple is not putting their stuff on Google or Alphabet. They're putting their stuff on Apple. So Apple's built in. You have all these apps, even with all the lawsuits that they have all the time, Apple's built in the base. So I like the subscribers and like how people can, that's built in money that's going to continue to flow. People are excited about the new phones. I don't know. My phone's fine. But once I got an Apple phone, this sounds like almost an Apple commercial, but it's not. I haven't really switched back over to another phone, but I think it's sticky like that with Droid phones as well, because I know people who have the Androids are pretty much stuck on their phones as well. It'll be interesting to see with the new CEO. And once again, like, you have the Knicks coming in, so we'll see how that transition works, because it's been a long time since the Knicks have been a threat to possibly win. Well, they've been a threat to win the East. They were a threat last year. They went to the finals, but the conference finals, but to go into the NBA finals. And people are really thinking that this could be their year, that they have the team built, they have some of the experience. So kind of like Apple just is performing strong this year. They're one of the final teams left in the NBA as well. Then you have Intel. Intel's meme-ish. Also a stock that I spoke with Samuel Brink last year. We were talking about Intel. This was right when the government came in to infuse cash into Intel. The government, by the way, has made billions of dollars on that investment in Intel since that time. Billions. I think they took a 10% take, but they've made billions and billions of dollars off that Intel investment. I think the government invested like $23 or $25 a share. And now Intel's $125, depending on the day. It also announced a partnership with Apple yesterday, so that boosted the stock some more. I think Intel's so we talk about earnings, and it started, the upper push from Intel started when it announced its earnings last month. And they announced, a good quarter. I mean, Intel has strong quarter, and Intel has struggled for so long. Intel's been a stock that I've actually paid a lot of attention to for a long time. Personally, I've owned Intel. I have some clients have them inside some Intel, but it's been a long time. We just didn't get Intel. We've been in Intel for a long time. But anyway, so you see Intel, and I watch Intel. It was like they were shooting themselves in the foot. I felt the same way with Boeing. Watching them, I felt the same way with GE before they did the split. But Mo is actually on the way back up as well, but it's just like it can't get out their own way. You see these things going on here, but then Intel, they actually got in a new CEO, came in, and there seemed to be implementing their plan. Like I said, that government infusion definitely didn't hurt, and becoming the American, I'm air quoting for those who are listening, air quotes. So the American first chip provider. I think that's maybe what they're kind of going for. But, there's a lot of optimism around Intel. But like I said, we're talking about earnings is why it's driving the market. Their actual earnings they're not earning a lot for this price. So as this price continue goes up, your PE gets higher. So that's not exactly a good thing that the stock expands, the price for what the actual earning is. You can think about, you're like, what do I mean? Think about a stock like Palantir. Palantir was like $40, went to a couple $100. The PE was extremely high, and just the multiples were high on the stock. So like what it was worth compared to like the actual earnings, just it was crazy. Wasn't really room for expansion. If you look now, you see that stocks come back down, and it's still high as far as PE goes. And that's Palantir. Once again, these stocks are an investment advice. Intel's kind of on that same trajectory right now. And also tied to the government was Palantir, but Palantir is software and defense. But Intel's kind of entrenched in that same way now. We see other companies coming in for partnerships with Intel to help Intel in different ways. And Intel seems to be meeting the standards. They seem to be delivering. That's going to be one of the big things is can they execute? And they seem to be executing right now. So if they can continue to execute, um, better or worse, Intel stock will probably continue to go higher. I mean, I just don't know if Intel is built to continue to go much higher just with the evaluation. But we'll see, stock market is a very interesting thing. But Intel, I didn't even say Intel who they are. Intel is like the Pistons, the Detroit Pistons, right? The comeback kids are fighting for a spot back in the elite rotation with, this domestic foundry industry right now. The Pistons are looking strong. Cade Cunningham's trying to show people why he was, or I would say he's showing people why he was a number one pick. Playing strong. I think who they're playing, Orlando. So against another number one pick. No, they're playing the Cavs. They're playing against the Cavs. Yeah, they're playing the Cavs. So just another, but Donovan Mitchell and the Cavs are tough. But they're looking to go up 3-0 on the Cavs. He's one of the top scorers in the postseason. And that's kind of what Intel is, right? They're trying to get strong with their foundry right now, but they will be tested because people don't know if if they have the experience. They've shown in the past, think about Detroit back in the day, the 80s Detroit, the bad boys with Chauncey Billups and those guys in like the early 2000s. That team was tough. They won a championship. So now we're just seeing this team's built the bigger championship, and Intel actually kind of coincide with those years too, as well as like their strengths. Intel popped before the second Piston dynasty went into effect. I don't know if one championship's a dynasty, but before that went into effect. But now here they are strong again. Intel's had very strong just stock performance movement. Intel's almost meme-ish at the rate it's moving right now. So once again, not investment advice, but you gotta be careful before you jump into these things. Just think about these things when you see something like that. But Intel probably has some room to go back up, but it definitely can come back down and extremely hard, right? And then who could be this year's Google, right? Who could be the underdog? Who could be this year's OKC in the playoffs? I don't know which NBA team that might be because, the NBA. But Microsoft could be this year's Google. And once again, not investment advice, but just think about Microsoft. Microsoft's down like 20% or something this year. They're shooting starved, they're shooting the wrong way, and they're way down with this massive capital expenditure that they're saying that they're going to undertake, and the returns, and people are waiting to see how they're going to monetize this. But once again, Microsoft is, they're a lot of pieces to that puzzle, and they have strong leadership. I didn't even mention how strong leadership was over there at Alphabet, but that helped play a part in their turnaround. People are looking at Meta in a similar statement, but Meta doesn't have a cloud. There are a lot of things that Meta doesn't have. Meta is arguably the best site when it comes to online advertisement, AI use. I don't know. I'm not on Facebook. I know WhatsApp was great for making international calls. It's a good tool for that. But Microsoft, I mean, you look at Microsoft, you have their Office suite. I think they actually had to reduce some of those prices this year, but you got, so you have Teams, you have Microsoft, you have, I don't know, people still play Xboxes. Isn't that Microsoft, LinkedIn, Microsoft? So I just have a lot of different things that are tied to that company as well. There's a lot of areas. They may be building their own chip, working on bringing in their stack, and they have partnerships with all these new AI companies. So people are really concerned with their capital expenditures. Microsoft could be, like I said, they could be like Google last year. You could see some crazy returns come at the end of at the this year if they can execute, even kind of similar to Intel. So who knows? We'll see with those stocks, but that's just, my thought on the NBA playoffs and the stock market right now. I mean, I know, thanks everybody for listening. We're over an hour in, and I still got a lot to say for those who want to listen. Who do y'all have win the NBA championship? Y'all like the Pistons, the Spurs, the Thunder. Who else? The Knicks. Sorry, Knicks fans. I think these are all the teams that are up in their series right now. So that's just what I'm basing it. These teams are up. Can't count LeBron James, that team right there. Maybe they still have some moves left to make, but just some of the things that we're seeing right now. So all that said, guess what? Still talking about my market views. Someone asked me about the markets. Stay invested right now if you have time. Not investment advice, but you don't want to try to jump in and out of these markets. I was talking to a guy who I worked with previously. He was telling me, I'm not going to say his name or anything, but he was telling me a story about what he's done since he left the firm that we worked at together. It's not my firm, it's a different firm. But he said that first he lost money at the beginning of 2025 because tariffs. I guess he just misplayed that investment. Maybe it was too quick. Maybe it's too swift. But he trades, so you can really get your whole face ripped off trading. But he made his money back. He got it back, and then he said, beginning of this year, he shorted Tesla, and he lost a lot of money doing that. I'm not even going to talk about where I saw him, but it wasn't financial advising anymore. It was definitely literally like a different type of job, whole different industry. And it's just like, that's trading versus investing for one. Two, I always caution against shorting anything. That's just my personal opinion. Especially if you're just, you're Main Street, you're not really paying too much attention. You got to be so nimble inside of shorting things. There actually an article last year where I was talking about shorting. People were talking about shorting Apple. It's like, you better be careful shorting Apple. That's something you got to jump in and jump out if you're going to do that. You got to be nimble if you're trying to short. That literally has unlimited losses if that stock just keeps going up. So be careful if you're shorting stocks. So stay invested. I say all that to say that if you have time in this market, stay invested in the market. If you see a dip and you see something that you like, that you have already researched, that your investment thesis goes into, or you already own, you can buy more of that, But I think these returns, one thing to watch. So he did ask, like, if I saw maybe a bubble, what should I look for? What am I looking for? I want to see these oil prices and the equities to go back to where they, if the oil prices went up, the equities are coming down. I kind of like to see that again, as just some sort of sense of normal movement in the market. I know that these earnings are great. I do like seeing these earnings, and the forecasts are strong. They're even kind of projecting out with oil for higher for longer, and they still see strong projections for these companies. I don't like what's happening on Main Street as far as affordability, because these corporations can project whatever they want to project as far as that goes. If Main Street buckles and we lose jobs, or we can't afford to pay our bills, we can't afford these extra things, there are some things that it won't matter. Some of these things, some of these companies are definitely going to lose a lot of money. Some of that cap expenditure will be too much. Are we going to overbuild AI like we overbuilt fiber optics? I think they built enough fiber optics to go around the globe like 30 or 50 times or something. I don't think we're going to do that because we see it more, but AI presents quite a threat for people anyway, so people are just, you're watching AI, you think about AI. So that's just a lot of time spent right there. If you are someone who's closer to retirement or you need cash right now, one thing you can do, I don't suggest just going all cash. I never really suggest that. You can increase your cash positions, find things that return cash to you, income producing products, but also look at how you're withdrawing your money, right? So if you have cash inside your portfolio, if you're retired, you should have some cash inside your portfolio. Pull from that. Hopefully you're pulling from that, not from an equity portion or something that's down that's in your investments, right? You don't want to pull from those positions right now. You want to give those things time to recover. So your secrets of returns matters, but the way you withdraw, definitely your distribution pattern matters even more, especially if you're early in retirement, about to retire. Be careful how much you're going to withdraw. Be careful how much you withdraw at the beginning. Um, don't start with a lot at the beginning. I mean, obviously you worked hard, you retired, it's your money, but be prudent. I know a lot of people now worry about outliving their money. That seems to be one of the things that people were talking about too. It's like, am I going to outlive my money? So be careful with that. Just stay the course. Hopefully you've thought about this before you got there. If you've accumulated some money, and if you just think, I don't know, it's too late, we'll just jump right into that. Right? Where do I start? So that was another question. Where do I start? Stay invested, but where do you start? So the question was, I see your videos, and you give a lot of good information, but sometimes I may get overwhelmed. It's just some of the dense information you give, I don't even know where to start. So the first question I asked was, because this person is employed. So I asked, do you have a 401k? Do you contribute to it? And do you have a match? Why do I ask those questions? Just in general, because if you have a 401k and you contribute to it, hopefully you're at least contributing up to the match, right? And that's one of the things that people don't realize, that that's going to be one of your biggest sources of income in retirement. Is going to be that the retirement income you're building on is generally one of people's biggest sources of income. People who retire in a different type of way. I know you'll get Social Security, but a lot of people now are planning financial plans without Social Security even in them. They want to plan out to where if they do get Social Security, it'll be a benefit. That's neither here nor there. We can build a plan to figure it out. So we figure out the plan whether there's Social Security in there or whether there's not Social Security in there. But that's more what I do inside of my at my firm. But this wasn't involved in my firm. It's just talking about what should I do. So make sure that if you have a 401k, make sure you're contributing to it, at least up to whatever your employer is matching. I said, ideally you want to get your savings rate, ideally just to start 10 to 15%. If you can get saving that, and I explained to them, to them, a general total savings rate, 10 to 15% is what you want to get. So if that includes, whatever you're getting from your 401k that you're saving, plus the portion that they're matching, then you want to have some savings in a emergency fund. That's one of the first things you want to build up. Like, you want to build up your emergency fund. That should be a goal, 3 months, 6 months, 12 months, depending on your situation. So if you got dual incomes and y'all work at different jobs, 3 months may be good, but you eventually want to build up to 6 months, because you have less risk for if one of you loses a job or something and you lose some of your income. Whereas if you both work at the same job, you probably want to have at least 6 months of emergency fund built up. If one of you lose your income at that job, it's going to be a little more detrimental, especially if you work at a job where you're getting benefits from the job, or you're getting stock options or things like that from the job. It can just be like a double whammy. And then if you just have one person who's working and bringing in income, you want to try to build it up to like a year for that. Also, if you're about to retire, I'm giving you some tips out here, things that you can start to do. You want to start living off of whatever your projected retirement income is. Try to do that for like a year or some months before you actually retire, so you can see what it feels like. So when it comes time to retire, you're not surprised by how little or how much you can live off of, and that may be something you need a financial advisor to help you figure out and plan out. But you want to try to start doing those type of things. So if you're, like I said, once again, so if you're a single earner in like a dual income, a dual family household, so like you, your spouse, maybe some children, but you provide all the income, you want to get to that 1 year level for your emergency fund, because if you lose your job or something, that could be detrimental for everyone in the household, and we don't want to do that. We don't want detriment. So that emergency fund is actually one of the first things that you need to look at building up, and you want to put that in a high yield savings account or something safe and very liquid that you can get that money when you need it. Yeah, you're going to pay more taxes on it, and there people can get into all kind of fancy things that you can do with it, but we're talking about basics. We're talking about, this is if you don't know where to start, this is a good place to start. Emergency fund and a high yield savings account. And inside of these things that we're beginning to write, because people usually maybe they have debt they need to take care of. So that's going to be a thing that you need to take care of too. People ask me, why not just do the debt first? Because sure enough, if you eliminate all that debt, you're going to get close to eliminating all that debt. Something's going to happen. You're going to have to, it's generally credit card debt. Something's going to happen, and you're going to have to put that money back on that credit card, and you're right back where you started. Whereas if you build up that emergency fund while also paying off some of your credit card debt, right? So there are different ways people go about paying off this debt at the same time with building an emergency fund. You can use, you have your percentages. Some people like to pay off the smallest debt first. So they like to see that go down and just go away. People like to see debt leave. Some people like to pay off the highest interest amount first, because, that just makes mathematical sense to some people. So they want to pay it off mathematically, whenever they can. At this point, if you're paying it off in that way, I think even when I was speaking with Johann Say Harrison, we were talking about just some of the different things he tells with his clients. He's telling you, so if you they're shocked when he tells them one of the things is, we're going to pay off this highest, whatever debt we're focused on, and then you're just going to make minimum payments on the other ones until we get that paid off, and then we're going to roll that money into the other one. Like that money that we were paying to that larger debt, once we pay it off, we'll add into the other debts and increase from the minimum payment until all that is eliminated. You also have to have realistic goals with your debt. Like you can't come to anyone and say you want to eliminate $1,000 of debt in 1 year when you earn $10,000 a year, and these numbers are all arbitrary and hypothetical, and your expenses are $10,000 a year. Like, come on, man! Like that's going to be tough. So you don't have realistic expectations. So we have to have some realistic expectations. So we got to set the expectations. We got to set the mindset. Like you got to understand the difference between why we're not doing this yet and that yet. You got to have time to sit back and just think about these things and trust. So you got to build a plan. I told someone yesterday, and obviously I didn't create this saying, but a failure to plan is a plan to fail, right? Or another one is a goal without a plan is just a wish. So that type of thing, like you got to set your plan up. You got to set your foundation up before you get into the other stuff. And then once you get the emergency fund and you get your debts going, then we really can look at some outside investors, maybe a brokerage account. Because you got to remember, you got your 401k. So, or whatever retirement account you have with your workplace benefits that's already invested. So that's going. You want to optimize that. But hopefully you're at least inside some type of fund. You're probably in a target date fund with your 401k. But hopefully you got your contributions up to where they're maximizing pre-tax versus after tax. Depending on if you're paying a tax bill at the end of the year or getting a refund. That's a good place to start. That's in one of my videos. So I got a video that's like basic blocks to begin. It's like a 20-minute video on that. It's where you want to start, why you want to start. It goes deeper into that. So further expanding into why a person would want to set up emergency funds and things of these sorts before they actually look at paying off all these debts or whatever kind of debt they want to look at paying off. You know what I'm saying? Another thing that people tend to forget about, and this is just something, with if you have debt, sometimes you can just call the company and let them know and see if there's a different way that you can pay it off, or you can set up some type of payment plan. You can look at consolidating your debt into something that pays off later, where you have a later payment time. But if you do that with your debt, like you put in a debt consolidation and it's like 0% balance, APR or whatever, until for 18 months, you got to pay that stuff off by 18 months. Because if you don't pay it off by the time frame, whatever the time frame is, you're going to get hit with the interest and penalties from all that time before. And that's going to be an even worse situation where you start. So, and there are other ways to go about it, but basically, yeah, you want to start. And a big part with the 401ks, a lot of people don't even have never even really like pulled them up. So that's a positive and a negative, because they got it set and forget that they're just constantly contributing. So these people are accumulating. People are accumulating inside of retirement accounts in that way, but you want to know what you're investing in. You want to know where one of your biggest sources of income in retirement, how it's set, and you want to understand like what you're investing in, why you're investing inside of these accounts, and that way. Yeah. So that's just kind of where we start, and that's it. That's what I would do, how I would do it. Another question, AI, as how I use AI in my job. I can talk about how I use AI a little bit more inside like the podcast and the videos. And I also talk about like how you can, things that, an example, like when I was in Jamaica, like AI can't do this. So for one, like with podcasts, I use for one Riverside. Anyone who, I don't know if people use Riverside, but I actually have a link if someone uses Riverside. You can try it out for a month free, but affiliate link, crazy. But Riverside, they do great stuff. So they take the AI, I record them, or I go live, and they go in and chop some of the stuff up. I'll spend time editing it or get over to the team, do the editing. But well, that's a good way I use AI inside it. That, or if I have someone coming on, I can use AI to like try and find our synergies if I don't particularly know the guest as well. Go in there and start with that template and put it in the prompt. One thing about AI is be careful what you put in that prompt, because what you put in that prompt, it's already made. You may prompt the AI perfectly already and still get a crazy result from the answer. Don't trust the math on AI. That's why I mentioned several times when we were looking at that math, like what's the math, what's the numbers, because it will give you terrible math. And AI will just also, it will just agree with you is what it seems like. So be real careful with what you're saying with that. You have your own voice. Don't let AI become your voice, right? If you're using it for editing, or if you don't, I don't use it for writing. So personally, I don't use it for writing. I'll let it edit some stuff if I write it, but it helps me with that. Like those type of things. It's like the podcast and the channel, because once again, I have a firm that I run, financial advisory firm, RIA, down here in North Carolina, the ABC Squared. So I have the firm, all bases covered. I definitely don't put it inside of my portfolios or people like that, or my clients' information yet. I am about to start integrating it more with, I'm about to try a little bit more with Hazel over there on Altruist. I use Altruist as a custodian. Hazel's just great things with that. So I like a little bit more into Hazel. But like I was saying, story about how AI can't, something AI can't do. So me and my wife, we got married 9, 10, 11, coming up on 15 years. And for our honeymoon, we went to Jamaica. So we were in Jamaica, and it was a sandals, because we're classy. Yeah, whatever. But it was a sandals all-inclusive resort. Cool. We lived in Duncan, South Carolina at the time, up in Spartanburg. It was like all you can eat, all you can drink, all you could everything. And we just went there and we're like off the map, you know. And I ran into a guy, like they had a pool that you could swim up to, like a swim up bar and all kind of stuff or whatever. But they had a piano bar. Some dude would come in there and play piano. They played piano, man, every night. Me and some dude were sitting there talking one night. We just started talking. We ended up talking about business. And he was like, yeah, I run a company. I told him where I was from. It's like, yeah, I run a corporation with like, I don't know, it was like 300 or 500 employees right up there in Duncan. Where you from? It's like, oh, or where you live? I was like, oh, really? You know, so talked a little bit more, and I was like, you know, man, you should let me come do whatever, you know, let my firm come do what we do, our corporate company come do what we do for you, you know, because we're good at it, and we kind of would serve that event that you needed. You know, he's like, yeah, whatever, man. It's like, next time I see you, I'm going to give you one of my business cards. And it was a resort. It was exclusive. You would see people. You could see the same people multiple times a day, or at least multiple times in the week, because you stay there for like a week or whatever. And I saw him like the next day, and I brought a business card, which is another thing. I don't even carry business cards anymore. And that's a whole nother story, because if I don't have a business card, we have to interact to actually like exchange information. So there's a reason behind not carrying a business card. Sometimes you need a business card. But I gave him a business card, talked a little bit more, and then I actually don't think I did see him anymore. So fast forward to like I said, this was September of 2011. Fast forward to 2013, like the beginning of 2013 or the end of 2012, well over a year, get a call to our like line where you have to call in to set this thing up. And they're like, yep, this dude just called in, said he met you in Jamaica. He wants to book this event for blah, blah, blah. It was a big event for like the whole company. You know what I'm saying? That was actually really cool. And it's something they continue to do. As far as I know, they're still doing it. Like annually, they do this event with this company. So what I'm saying is like AI couldn't have done that. AI couldn't have just, there's no bot yet that's going to talk to this guy. We couldn't have just had that conversation and made that connection and made that relationship, you know? So keep your interpersonal relationships where you can talk to people, where you have communication skills, where you're not, that's something that's lacking in today's generation, where people just seem to be afraid to talk to people. We need to work on that. You have to be able to talk to people, and you have to be able to differentiate yourself, right? You have to know who you are, what you bring different. What's your superpower, as some would say, you know? What is your superpower? What's your differentiator? So that's just another way, like, yeah, AI is going to calculate stuff faster than I can every time, but it'll probably calculate worse than I can for sure. And that's a concept that I like to call, you know, and I didn't invent it, but it's MBWA squared. So managing by walking around, marketing by walking around, right? So I wasn't particularly managing. I mean, I was managing myself because, like I said, it was inclusive and it was my honeymoon. This was a long time ago. Marketing by walking around. That's like even when you're out. I think Michael Jordan explained it best. I'm not comparing myself to Michael Jordan, but he would say when he went out in public, he knew some people would see him only for the first time and they would never see him again. And to some people, that would be quite the experience, right? And he doesn't even mean like playing basketball. He just means like out in the world, right? People see him. I don't know if you've seen Jordan or especially how he used to dress. He always wore like nice custom suits. And I mean, obviously only Jordan brand stuff, I imagine now, but he's marketing by walking around, right? And clearly he's managing by walking around when he's playing basketball, right? So that's the action of it. And then that's the marketing part, you know. I was marketing by walking around while I was not even meaning to market when I was in Jamaica, and we were just talking about what we're doing, you know, just let them know, I can fulfill that project that they need. And also, another thing about that is that you have to execute. We executed. I was there for the first couple of them. We executed that, and then they continue to do. And you have to, this is in life. This is for, I know some business owners listening to this and some leaders, also in your family. You got to take these things, iterate them, but you have to grow where you can let go of them as well too. Well, it can grow without you being there, and it still works. And that's not saying that I had the system. I was in a great system as well, just with some great people who ran a great business. Yeah. So that's once again, AI, good luck, AI. Come get that. Thanks for everybody still listening. Once again, like I said, I told you it's going to be a long one. We're about an hour and a half in, and we still have stuff to talk about. So I just appreciate it. But once again, I'm answering your questions. I want to answer people's questions thoroughly for anyone who's listening. So thank you for listening, for one. I want to talk about Trump accounts for a second. These new Trump accounts, a lot of people have been watching and asking questions about Trump accounts. So I'm actually going to just pull up some notes I made myself on the Trump accounts. But for those who don't know, I've been talking about Trump accounts. I actually started on the podcast for normal people with Christy Amato, and we were speaking about the One Big Beautiful Bill Act. That's where we started. And then I'm looking for this Trump account stuff. And then we eventually went to it's just a monthly market update. We do monthly, we would sit down and we talk, but we did, we started last year. So we were talking about these Trump accounts for a while. An initiative fueled by Brad Gershner, and a lot of people on the private credit side, private sector side, not private credit, but the private sector, people who weren't necessarily in the government. And so what it is account for anyone under 18. So you open an account, and I actually got a deep dive, like 34, 35-minute video. That's a straight up tutorial that'll show you how to walk through it. So we don't have to spend 35 minutes on right now, but it is something that's coming up in the news a lot lately. Full disclosure, signed my kids up when we did our taxes for theirs. It was just a box that you check, but if you need to still sign up, if you've already filed your tax and haven't done it, that video that I have is like a 30+ minute walkthrough. It shows the projections. It shows like if you stay investing in these accounts, and they're just a big subject, a big topic right now, and they're further along than they were when we initially created the videos. So I do want to talk about them a little bit more now, because there have been some updates since we filmed the videos. But like I said, so if you have a child that's born in between 2025 and 2028, and you create a Trump account, so you have to go online, IRS form 4547, go online, fill that out. That child will receive $1,000 seed money inside the account, and it was initially set up so that $1,000 seed money can be invested inside a mutual fund or index that tracks U.S. companies, and it can grow and stay with that child until 18 or until they retire. It will turn into an IRA once you reach a certain age, and if you use it for certain things, you can take the money out for tax-free withdrawals. Some of those things being college, starting a business, purchasing a home. So once you reach like 18, you can take it out for those things without a penalty or without taxes, which is cool. This is a good initiative, and big part of it is hopefully it pushes and helps people with financial literacy. That's one of my big things. Once again, while I'm on here talking right now for over an hour and a half, trying to spread some financial literacy. So if you're listening, you're still listening, I appreciate it. I think my beard's got a little greater during this conversation. But if you're listening, this is why we do is share this information with people. I'm not saying you should go start a Trump account or saying you shouldn't. I also have 529s for my kids, right? Which I had before these Trump accounts. But I'm looking at different ways that, to diversify their investments for them and set them up for possibly reduce college expenses and, just money that they can use if these accounts work to turn out to be IRAs for them. Like I said, so inside the Trump accounts, they invest inside of U.S. index funds, and they start with $1,000 seed money. One of the things that we've seen, so for kids born 25 through 28, but one of the things we've seen now is a move by private individuals to invest inside these Trump accounts. And by invest, they're donating money to certain, to these accounts. I think it was Dale. I've said this a lot. Michael Dale and his wife, they've donated $6 billion. It comes out to like $250 per account to children, like all children under 18. But I think it's like certain zip codes. Of course, as these things come out, like there are always more intricacies behind everything. But one of the things, so you have that, and then you have other individuals now who are coming out and investing inside these Trump accounts, right? So that's inside the video that I have, and it shows the projected growth. I think you can invest for like up to $5,000 a year. You can contribute up to $5,000 a year, and anyone can contribute. You can just send them a link. So it's kind of like the 529 with that, where you can just send them a link and they can contribute to their account. But it works better if a parent actually sets up the account for the child. So you're going to want a parent to set up the account for their child, but the account's actually a child's account. So that's a cool thing. So hopefully parents can't go in there and just, take the money out of these kids' accounts, because we've seen too many kids. I don't know if you've seen it, who had bad credit before they even got old enough to have credit. But somehow or another, their parents. That's another story. I digress. The Trump accounts, and they grow. But another thing, since that long video that I did, the 34-minute video, that's not long. This is getting a little long. Is that they've added, they're proposing where people can take individual stocks and put them in there, individual stock positions. So that would be different. I think they would have to actually have an executive order or amend the law, or I guess, I don't know if you amend the law. They have to change the law somehow. Since they just signed it, they codified it into the law that it has to be only U.S. investments and index funds. But there are a lot of people who own a lot of stocks, right? So this can be you, Main Street, right? This just doesn't have to be like billionaires or people like that. Sorry, I took a drink of this Deerport for those not watching. But Main Street, if you have, say you have stocks inside your positions and you want to donate issues or something, or you got a ESOPP plan, who knows what you have, ESPP plan, employee stock incentive plan, but who knows what you have, or the purchasing plan, and you want to donate it to the kids, because that's one of the things with the stocks. People do a lot with the donor advisory funds. You should check out one of the podcasts. I have episodes with Mr. George Hoppenfuhr. It's called By George We Got It. But he talks about how he started donating money in his children's fund. So he donated, and to charities, not his children's fund, I'm sorry, how he donated to charities through his donor advisory fund, stocks, that good picks he made. And this was back in the 80s. He's also someone with well over 40 years of investment experience. We have some great guests on this show. For those who don't know, you should check it out. If this is your first time listening, go back and check out some other stuff or watching. We've had some really powerful guests on here with some great information, some great knowledge. But with the Trump accounts, so like I said, you have inside these Trump accounts, and they can grow, but now I have people where they can take like those donor advised accounts, and they can take, or even just individual stocks, and put inside there. They haven't ruled on that, whether that's what it's going to be or yet, whether that will be the provision yet or not. But that's definitely a thing they're looking at. I've heard it announced just the other day that that's a thing. I think, like I said, Trump will probably have to sign an executive order. That probably would be the quickest way to get it done. But, if you're helping kids' stocks grow or helping their retirement accounts grow, it's hard to be mad at that. Financial literacy part is going to be a big part of it. The tax breaks, people get mad at that because these donations would be like tax-free donations for the people donating. The financial literacy part is going to be huge, because kids, if they do have individual positions in there for that long, they will definitely see some of those things go way up and some of those things go way down. Think about if you were a kid and got a Trump account in the late 90s and you had Intel, right? And you saw it go up and you saw it go down, and now you see it way back up again, but you would understand how these stocks work. Like I said, sometimes they go up, sometimes they go down. Intel may not be the best example for that. Microsoft might be a better example for right then, because it was, went up, went down from the boom. But you just want to, the time invested in these stocks or in these indexes. So anything to boost financial literacy, I really think is a good move. Also inside these Trump accounts is something that I didn't have on the video last time, is that some of these companies won't allow their people to invest in yet. You can't invest in these accounts yet. And some of these companies are like companies that do audits for individual companies. They just don't know if they have stricter regulations, companies where you got to report your trades. Some of these companies might go in and audit these actual companies, so they got to make sure there's no conflict of interest inside what they're investing in. They actually can't invest in these companies in their personal positions either. So it's just the way it is with some of these things. So that's another thing, everyone can't get invested inside of these. So right now, but if you can, at least take a look at it. Like I said, I made a long video on it. Take a look at the video. It can't hurt you to look at it. You can learn some stuff on there. You can learn something. No, but for real, you can learn some stuff on there if you sit back and listen. Just watch it, because there's a lot of it, and you can make your own informed decision. Because remember, once again, financial literacy, the ability to, digest, evaluate, and make informed decisions. That's kind of my personal definition of it. You can think of it however you want. Think about it wherever you want to think about it. So Trump accounts, and I appreciate y'all. We're deep. We're into this well over an hour and a half. But like I said, I wanted to answer everyone's questions that they've been asking, and these are usually like 20-minute conversations that I'm having with people anyway. So here we are on investment filters. We said we were going to talk about those. So once again, there's an investment advice, but these are some things that, people want to know when it comes time to invest, because people are always coming up with good ideas now, quote unquote good ideas. Everyone has a master plan. Everyone has the next best thing that's going to make everyone a gazillionaire, and they can't believe you didn't know it, and they can't believe that you're not investing in it. So everyone has. But some questions that I like to ask people, and this list can go way deeper than this, way further than this. One of the first things that you can ask or to think about an investment filter. So think about the taxes, right? Because people always think about the returns, but think about like the taxes. What taxes are you going to pay on this? Taxes play an important part. I've heard lately where people keep mentioning, and the internet's. The internet is the internet, where people keep mentioning that they are planning their taxes with huge losses inside their investments. And I'm just like, that's not exactly how I want to plan for my clients. Like, I understand you will have some tax loss harvests inside that, but I'm not building out a plan based on large tax losses. That seems like taking 2 steps back to take a step forward. Not even 1 step forward and 2 steps back. It's the other way, right? So taxes, think about taxes. Then if you're actually sitting here with this person, right, you need to ask these are some good questions to ask this person, right? How do you get paid? Not me, but how do they get paid? So how do you get paid in this transaction that we're talking about? How do you get paid in this investment? That's a good question. Ask them if they get paid before you get paid, right? So when do they get paid? That's a good thing too. Like, let me know the fragility of this investment or this relationship. Like, are you done with it once you get paid? Or is this a strong relationship with a lot of anti-fragility in it? So is it durable? Or is this you're going to get your commission in dip? So that's a good question to ask too. Then you can ask them, so like, how do I actually get out of this investment? Like, so let's sit here and let's say it does go great. Let's say it's something where I'm supposed to be locked up for 2 or 3 years. We've actually done the 2 or 3 years. The investment's done exactly what you said it would, but it's time for me to get out of this thing. I think it's time for me to do what is our strategy for me to get out? What does that look like? What is the strategy? How do I get out? And let's say something happens. I know in this investment, maybe I planned on it to be a little bit longer. Something happens, I need to get out of this. I need this money right now. How bad is it going to cost me? Like, not how bad it's going to, how much it's going to cost me? What's the hit? What's the penalty? What's that number going to look like? Worst case scenario. Explain that scenario to me. These are all separate questions, right? So what does that look like? Another thing that I always like to think about, and I always like to tell people, like, if you're investing money inside something, think about what it looks like if it goes to zero, right? What does this look like if it goes completely to zero? Because you shouldn't jump into an investment with everything. Like, even with those athletes' portfolios, even with the ones they had, they still weren't 100% invested in anything, like one particular area. But you don't, not the ones that didn't go broke, but you want to diversify. You don't want to jump into every one thing completely head over heels into it, just without fully understanding it, right? Like, you have to know these things before you invest. You want to know, compensation. Like I said, does the get paid before you exit? How do I get out? And then zero scenario. If this fails, does this break your retirement plan? Like your, retirement message? Does this break it? Things just to think about, before you get into any type of investment, especially with all this stuff going on in private credit right now and these type of investments. There are definitely some good opportunities out there, but you need to understand these things that you are investing in. You need to understand it, not just your financial advisor and the person bringing it to you. It's your money. And if the person who's bringing it to you, your financial advisor, has a problem with you asking questions about it, or if that person who you are talking to gets offended or something, or they can't explain it when you ask them questions about it, come on, man. There's a lot of ways to invest and make money in the world. And it seems like this might not be the one for me, right? You can just tell them that. Just simply let them know, like, this isn't exactly what I thought it was going to be. And I don't think I'm going to get involved in it. And they should be fine if they're any part of, I guess, your proverbial mustard. They cut it. They have another idea for your client. Financial planning. They're not just selling a product. They're developing a plan for you. They're helping you figuring out a plan. Right? It's been a while. I've been sitting here talking for a minute, but there are other things. Thanks for staying with me so long. This is a long episode, long video. The other thing that people have been asking me about lately is, and this will be out. This will be out in the article, but it's not out yet. and they want to know, let me frame the question correctly if I remember correctly, is what are invest expectations for retirement? So investors' expectations for retirement versus their actual reality for retirement. And I analoged it to like dating or being single when you're younger and your expectations for what you want when you get older or your expectations when you get married. So if you're like 20 or whatever years old, and this goes for either sex or whatever, it just goes for any person, right? So say you're like 20 or however old you are and you want to get married, like that's one of your goals, and you probably have an ideal partner, whatever that partner is, and they're, I don't know, the perfect height, the perfect weight. They're the most beautiful person, if that's a thing for you, and they earn whatever that you need the person to earn, whatever it is. Those those expectations are probably unrealistic anyway, right? I think I saw something where they were saying like they took a survey, and obviously surveys are in polls, but like the expectations people were having at these ages were like, there was only like 2% or 6% of the population who met these expectations for either side of the sexes, right? So like for whatever it may be. So that right there, so that's like kind of what people think maybe when they first go into looking at retirement. People want to retire and, be gazillionaires when they retire, but they don't actually want to put in the work. They don't want to do what they need to do to reach these goals. Saving, proper allocations, the building blocks, as we mentioned, and evolving as their portfolios and their retirements evolve. So they have these unrealistic expectations where they're going to live off $1 million a year, go across the globe every year. But once again, we didn't think about taxes. We didn't really think about this investment filter. And we're not accumulating enough money. So we're not really thinking about this real personal other side of this marriage. But as this person stays single longer, and then they get closer, those expectations come down. Maybe that 6'5" man is now only, taller than me. As long as he's taller than me. Like, or, maybe where they had to earn 300,000 now, it's just like, as long as they can help me make ends meet, not ends meet, but we can survive, live comfortably together. We don't have to have an exuberant lifestyle. We can have a good lifestyle together. We can just build together. Those type of things that change, those expectations. Same thing happens when you get closer to retirement, especially if you haven't properly prepared. If it's something that kind of sneaks up on you, and it's snuck up on so many Americans, even though it says on the site, Social Security is not meant to replace full retirement funds. People think that they're going to live comfortably until whatever their standard was before they retired, basically off Social Security, and that's not really ever the case. So, like I said, once you get married, or once you've been single and you're older, those expectations change, and the same thing may change with your retirement. You may say, instead of wanting to live off $1 million a year, maybe now you want to make sure you have enough. Like I said, one of the big things people are talking about now is they don't want to run out of money. They don't want to outlive their money. You have to think just a couple generations ago, people had pensions, and it was pretty hard to outlive your money, right? Not impossible. Nothing's impossible. Few things are impossible. Now there's a shift to where that's one of the things that people worry about. But once again, if you set up and you plan it, you can project it to live longer, because people are living longer now, and you can project your money to live longer. But a lot of that, like I said earlier, has to do when you invest money, when you withdraw your money, and the taxes. So those couple things and put together are going to have a lot to do with how long your money lasts, how you withdraw, when you withdraw money, your withdrawal strategy. So like I was saying, your standards may change, right? You may just want to figure out a way to have your debt paid off. You can cover your bills. You can take a couple trips a year. And you don't need $1 million a year to live, right? So that's that. Just a little bit taller guy than you, you know what I mean? Just who y'all can build together and those type of things. And why that's not, it's funny, but it's not funny, because you have to have the mindset, and people's mindsets shift the older they get. Hopefully you're mature and you're growing, you're understanding like, oh, okay, I got it. This is not the same, right? So just think about the topics that we talked about, today. The dilution, the diluted game, what I'm saying? You can't date a diluted currency. You're going to have to marry that asset. The printer can't really be out here just touching it. And retirement, like I said, it's just, it's logistics in marriage. A healthy couple may need, and these numbers, they may need six figures for healthcare in retirement. People don't plan for that. People don't think about those type of things anymore. It's just, you just never know what's coming, but you can prepare. You hope for the best, but you prepare for the worst. Also, realistic expectations. That's a big thing with it. That's a big issue for anyone investing, anyone inside the world right now. You have to have realistic expectations, and you just have to know what's going on inside your world. You have to know what you have. You have to know where you're invested. Just want the world to know once again. So this has been a long one. I really appreciate people who've sat back. Make sure I've covered everything. I think I've answered all the questions, right? So the first question was, why don't we print more money? Then we were talking about where do we start? I spent a long time talking about like why I think currently in the markets and just where I see. I only think I talked about Kevin Warsh, So we got Warsh coming in with Chairman Powell. The new Chairman Powell said he's going to stay on as a governor until this investigation is concluded. So that adds a big layer to the whole situation. We'll see how that plays out in the long run with the Federal Reserve and interest rates, whether they'll be hiked or lowered. Marketing strategy, a cool little story about Jamaica, and how AI can't just take everything over just yet. Learn AI. Learn how to use AI. Don't learn how to fight AI. We talked about Trump accounts, a good little refresher on Trump accounts, some of the updates to those, and then some good investment filters to use, before you make a pick. And like I said, none of this stuff is comprehensive or extensive. Some of it is extensive, but not comprehensive. It's just what I want to share on Main Street, answer some of the questions. So this is a mailbag style. This is a long one, a couple hours. I appreciate anyone who sat here and listened. As a reward, anyone who wants to check out some market research, you can check out Trivariate Research from Adam Parker. You mentioned Marcus. Say my name. You can get a month free there. You can go to Monarch Money if you are looking for a budgeting tool that helps with, it integrates AI. It's great for couples looking to see everything all in one place. If you're a new college grad and you're trying to figure out where everything is, your student debts, your 401k, your banking, your checking, your savings, those accounts, you can all put them all in one place and you can share it with whoever you choose to share it with that you're budgeting with. So that works great for spouses as well as students or your financial advisor. I'll leave a link for that as well. Yeah, man. Street, I just really appreciate you all sitting here with me. I'm almost hoarse. My mouth is dry. I'm thirsty. Appreciate the people who sat back and listened. Once again, shout out to all the people who listen. We got a lot of people listening in America. We got a lot of people listening in America. We have a lot of people listening, like I said, in Asia, Japan, South Korea, Vietnam. There's a lot of people over there in Indonesia that just taking in Australia. It's really global what's happening. So thanks for everyone who's been a part of that. The Wall Street South Journal, like I said, it's over 1,300 subscribers. That we actually kind of went over that last issue where we talked about employee athletes and going broke. But once again, that can happen to anyone. Good look at the model portfolios that they had back then. And just to see the returns, I mean, I feel like this is just a lot of value for anyone who wants to sit back and listen. So share this with people. Please share it with people. Subscribe to the channel if you want to hear more. I promise y'all, sometimes I'll be going solo on podcasts. This is a long one, a long solo dolo one. I hope I answer all the questions. I'll do this again. So if y'all have questions, that's why I say leave questions, leave comments. Give the show a 5-star review. That helps people. Leave comments, questions, subscribe to the channel. Check out the Wall Street South Journal. Once again, Main Street Heart meets Wall Street Smarts. Appreciate you tuning in. We'll see you soon. Thanks for the deep dive. But yeah, we talked about the playoffs. So let me know who you got, who you think's going to win it all. OKC repeating? I don't know. We shall see. And that right there, I feel like that right there is the logic of the ledger for right now, a playoff edition. Thanks for all who tuned in.